On this channel, guys, we talk a lot about stocks and how to make money with stocks, but we also talk a lot about options and exactly how you can make a ton of money in options. Now, there are a lot of terms that people use and kind of throw around for options, and I want to talk to you about those today, right here, right now. I'm talking about terms like in the money, at the money, or out of the money. And depending on if your option is in one of those three states can be the difference between you making a lot of money and you unfortunately losing a lot of money. So the goal for this video is to educate you so that later on in other videos that you watch on this channel, we talk about options, it will greatly amplify what you're able to do with those other videos. Right? Those will be videos where we talk about actual strategies that you will use to make money, and we will take what we have learned here, build upon that, understanding these terms so that when you see them later on, again, it will greatly amplify what you'll be able to do with that content. So here we go, clicking buttons. I'll see you guys inside the computer. All right, everyone, we're back inside the computer. Again, the purpose of this video is to educate you on a lot of the terms that we're going to use in later on videos when it comes to how to make money, and specifically a ton of money with options, right? And this video will amplify the takeaways and what you're able to learn and understand, and how quickly you're able to learn, understand, and implement the option strategies that we have later on. So this is very, very important. Although there's no exact strategies here to make you a ton of money, this will amplify every other options video that we have on this channel. So it's super, super important. And the terms we're talking about today are in the money, at the money, or out of the money. And this photo of mine is the best photo that I've ever taken in my entire life. It has to be photoshopped. If you ever see me speak in any events, ever see me walking down the street, there's no way I look this good unless I have tons and tons and tons of makeup on. So I love looking at this picture. I've never looked that good in my life. All right, in the money, at the money, out of the money. These are terms used when describing options. And again, if you understand these terms, the takeaways and the learnings you're going to get and the ability to execute strategies later on is going to be crazy. So, what? In the money, at the money, and out of the money, they're terms used to describe the current status of an options contract. So whether your option is in the money, at the money, or out of money will give you a good understanding if you're up money, down money, if you're looking really good, or if you're in a lot of trouble. So again, I state this all the time because it's important. A lot of people get really kind of confused with options. They don't really understand them. They're not confusing at all. Options are a contract or agreement to buy or sell 100 shares of stock for every one option we hold at a predetermined price and a predetermined date. Right, so every option is worth 100 shares of stock, and something happens, a buy or a sell, at a predetermined price. That is the strike price of the option, and a predetermined date. A predetermined date is when an option expires. And in the money, at the money, and out of the money are terms used to describe the current status of those agreements or contracts. That's it. Nothing more, nothing else confusing. So when does it matter? All right, when does it matter? Why does it matter? Well, these terms matter most when options expire, that whole predetermined date thing. As depending on the status of an option at expiration, holders of options, buyers or sellers, may exercise or be assigned stock. Now this happens for all in the money options at expiration. Again, don't worry, we're going to get into it right here, right now. So at expiration, options can only be in the money or out of the money. Now there was a third one that we talked about here, at the money. At the money is a term used to describe the options contracts that are closest to the current price of the stock. So right now, actually this one's a little messy. So right now, the current price of the stock, we're looking at SPY. This is the S&P 500 Index ETF. This is the single stock with the most participation in the world. 144 million shares traded in a day. That's big. And again, at the money, which is very irrelevant at expiration, because at expiration, options can only be in the money or out of the money. and you'll hear why in a second. At the money is the options that are the closest to the current price of the stock. Right now, 266.50 is the current price of the stock, which means the 267 strike is the at the money strike. So if we are buyers or sellers of the 267 strike price, those are the at the money options. And again, once it comes to expiration, it's actually kind of irrelevant at the money. So in the money and or out of the money, those are the only two statuses we can have at expiration. So let's get into exactly what those two mean. So in the money options, and I'll give you a million examples. So don't worry, you'll never be confused about this ever again. So at expiration, owners of in the money calls will be the owners of 100 shares of stock for every in the money call we own at the strike price of those options. So if we go back to the exact same options chain as we have right now, this option chain expires 40 days from now. But let's say it expires right this second, and we are the owner of a 265 call. We know that the 265 call is an in the money call. And the reason we know it's in the money is because the price of the stock, 266.51, is above our strike price being 265. So again, at expiration, owners of in the money calls will be the owner of 100 shares of stock for every in the money call they own at the strike price of those options. So if I look at this options chain, which options are currently in the money? Anything 266 and down. 267 is not in the money because right now the price is 266.51. So 265 is an in the money call. 262 is also in the money call because the price of the stock is above our strike price. Our strike price is 262, and the current price of the stock, again, 266.51. That makes it in the money. So if we held a 265 call into expiration and the current price was 266.51, because it's in the money, we would be assigned 100 shares of stock at our strike price being 265. So 265 times 100. We would have 100 shares at 265 for a grand total of, we would, for margin requirements, we'd have to put up $26,500. Now, where it gets interesting is the fact that right now, the price of SPY is above that. So 266.51 times 100 is is more than 265 itself. But rather than being an owner of 100 shares at 266.51, we get to be an owner of those shares at 265. So we're making $1.51 or $151 per every one 265 call that we have. That's an in the money call at expiration. So at expiration, sellers, the other side of the in the money calls, will be short 100 shares of stock for every in the money call they have sold at the strike price of those options. So at the opposite, right? So if we're a seller of a 265 call, at expiration, that 265 call is still going to be in the money because the price of the stock is greater than the strike price of the call. But rather than being long 100 shares of stock, we're going to be short 100 shares of stock. So rather than being a $1.51 winner per share, we're going to be a $1.51 loser per share. So we will be short 100 shares of stock at $265 a share. Same thing as if we held the 260, if we were short the 262 call at expiration, we would end up being short 100 shares of SPY at 262 a share. We would be a $4.51 loser per share because we are short at 262 and the price is 266.51. It's gone against us, right? It's gone against us by $4.51. That is what happens if we're a seller of calls at expiration and specifically in the money calls. So at expirations, owners of in-the-money puts will be short 100 shares of stock for every in-the-money put they own at the strike price of those options. So differently than calls, if we were long a 270 put, in order for the put to be in the money, the price of the put would be below our strike price at expiration. That is an in the money put. And if that is the case, we will have 100 short shares of SPY at 270 a share. And because the current price is 266.51, we are profitable by $3.49 a share. We're short them at 270, right? So we're short them at 270, and the current price is 266.51. So we are profitable $3.49 per share. So if we end up having 100 shares, we're already a winner at expiration with our in the money 270 put by $349. That is what an in the money put is at expiration. You are getting short 100 shares of stock for every option that you are the buyer of an in the money put at expiration. Right? And conversely, at expiration, sellers of in the money puts will be the owner of 100 shares of stock for every one in the money put they're short at the strike price of those options. So if we were short a 270 put, we would have to get long 100 shares of stock at that point. And if we were long 100 shares of stock at that point, 260.51 minus 270, the price of this stock is 266.51, but we had to be buyers at 270 a share, right? So we're a loser of $3.49 initially, or $349 per every 100 shares. So, kind of to regroup, in the money calls at expiration, you get 100 shares of stock at the strike price. So if you were the owner of a 263 call at expiration, you would own 100 shares of stock at $263 a share. And a call being in the money is the price of the stock is greater than the strike price of your option. Now on the other side, sellers of in the money calls, they will be short 100 shares at the strike price if the call is in the money. So if the price of SPY is greater than a call that you own, let's say the 264 call, so that you're short, you have to sell 100 shares of SPY at 264, and you are already a loser in that case. Now on the other side, on the put side, if we're the owner of an in-the-money put at expiration, right, and the way we're an owner of an in-the-money put at expiration is if we own a put where the strike price is greater than the current price of the stock. In this case, the current price of stock is 266.51, so something like the 170 strike, again, is greater than the price of the stock. That is an in-the-money put. If you are the owner of an in-the-money put at expiration, you will get short 100 shares of stock at the current price. So in this case, at 270 a share right here. Now on the other side, if you're a seller of in-the-money puts, let's say the 270 put, you will be the owner of 100 shares of stock at expiration, right? Or long 100 shares at 270. So you'd be long 100 shares at 270. And again, in the money call, the price of the stock is above the price of, or the strike price of the call. In the money put, the price of the stock is below the strike price of the put. That is what in the money means. Now, out of the money means is kind of on the other side. Out of the money is a little bit different. At expiration, owners, right, buyers of out of the money calls will have realized a maximum loss of the value they paid for that option. So, what is an out of the money call? An out of the money call is a call option where the strike price of the option is greater than the current price of the stock. So if we were an owner of the 270 call at expiration, the 270 call would be worth zero. Only in the money options at expiration have any value. So if we were the owner of a 270 call and 270 was above the current price of the stock at expiration, we would have lost any amount of money that we have paid for that option. Now, on the other side, we're looking at if we are the seller of an out-of-the-money call, we will have realized a maximum profit of the value we sold the option for. So if we were the seller of a 270 call and the call was out of the money at expiration, and the way to figure out if it's out of the money at expiration is if the strike price of the option, in this case 270, is above the current price of the stock, in this case 266.51, because only in the money options have value at expiration, this out of the money would have no value. Thus, it'd be worth zero. And since we're the seller of the option, we will make a maximum profit of whatever we sold the option for. So if we sold this option for $1.45 and at expiration it was out of the money, we would have made a maximum profit of $1.45. Okay? Now let's look at the other puts. At expirations, owners of out-of-the-money puts will have realized a maximum loss of the value they paid for that option. So, an out-of-the-money put, 260, let's go, 262.5. Let's say we bought that. An out-of-the-money put is a put where the current price of the stock is above the strike price of the put. In this case, 262.5 is definitely below the price of the stock, making it an out-of-the-money put. Buyers will have realized the maximum loss because out-of-the-money options have no value at expiration. Only in-the-money options have any value at expiration. So obviously the other side of that is sellers of out-of-the-money puts will have realized the maximum profit of the value they sold the option for. So if we sold this 262.5 option for $1.25, that's what the mid price is right now. At expiration, the value of this option would be zero because it's out of the money. Again, the strike price of an out-of-the-money put is below the current price of the stock. 262.5 is our strike price. The current price of the stock, 266.5. It's clearly below that number. So at expiration, because this is not in the money, because this 262 put is out of the money, it will have a zero value. Thus, we would have realized a maximum profit of $1.25. So, out of the money calls. Out of the money calls are those where the strike price of the call is above the current price of the stock. Out of the money puts is where the strike price of the puts is below the current price of the stock. That are out of the money options. So, that's what in the money is. That's what out of the money is. Now, clearly, you want the following. If you are a buyer of options, you want those options that you have bought to be in the money at expiration, as only in the money options have any value at expiration. So if you buy something, you want the value of that to go up. Thus, you want your options to be in the money at expiration, otherwise they're worth zero. So if you're a buyer of options, puts or calls, if you're a buyer of puts, you want the strike price of your put, if you are a buyer of calls, you want the strike price of your call to be below the current price of the stock. That would make it in the money, and that's the only way a call can have any value at expiration. If you're the buyer of a put, you want the strike price of the put to be above the price of the stock. That is what an in the money put is, and that's the only way your put will have any value at expiration. Now, on the other side, if you're a seller of an option, right, you want them to be out of the money at expiration, as there will be no value in those, right? When we sell something, we want the value to go down. So if we sell options, we want them to be out of the money at expiration. For a call to be out of the money, the strike price has to be above. That's right, the strike price has to be above the current price of the stock. And an out of the money put, strike price has to be below the current price of the stock. We're selling the option. We want the price of something that we sell to go down. Thus, if it's worth zero at expiration, that's what we want. So we want options that we have bought to be in the money at expiration, and we want options that we have sold to be out of the money at expiration, right? Again, in the money options, they have value at expiration. Out of the money, they do not have any value at expiration. So, if we're looking, let's look at another stock like Facebook, for example. Facebook let's go over here. Facebook right now is trading for, let's call it $1.80, or excuse me, $180. If we own a call, we want the call to be from the 180 strike down. This way at expiration, it will be in the money. And if we're buyers of puts, we want to buy anything that is the 182.5 strike up. This way it's in the money. Remember, an in the money put is something where the strike price is above the current price of the stock. Remember, if we're buyers, in the money puts. If we buy calls, in the money calls. Now, if we're sellers of calls, we want the strike price of the call from here down. We want the strike price of the call to be above the current price of the stock, right? Over here. The reason we want that is because when we sell something, when we sell calls, when we sell something, we want the value of them to go down. Out of the money calls at expiration have no value whatsoever. Thus, we want to sell them. And we hope that they're out of the money at expiration. Same thing for puts. The strike price of an out of the money put is below the current price of the stock. That is anything from 180 down, right? And if we're sellers of puts, we want them to expire out of the money because they will have zero value at expiration. So again, guys, that's at the money, that's in the money, and that is at the money. Those are key terms. So if you're a little confused, ask me some questions in the comments below. If you're a little more confused, watch this video again, or I could redo it. Again, in the money, at the money, out of the money. Those are very key terms that will allow you to amplify everything else that you're going to be able to watch on this channel. I'm glad you guys are able to watch that video. Again, terms like that, in the money, out of the money, at the money, they serve a huge purpose. Right? When we talk about all of our other awesome strategies that revolve around options, we talk about those terms in the money, at the money, out of the money. And what you have learned here will drastically amplify all those other lessons. It will drastically amplify it because you'll be like, boom, at the money, I know exactly what that is. And so thank you guys so much for watching this. If you have any questions, hit me up in the comments below. I can redo the video if you want. If you guys don't understand it, watch it a few times because, again, in other videos where we're talking about serious money-making strategies with options, we're definitely going to be throwing in terms like in the money or out of the money. So again, guys, if you are a buyer of options, puts or calls, you like them to expire in the money because when the options are in the money at expiration, it's the only way they have any value. If you're the seller of options, you want them to expire out of the money because out of the money options at expiration have no value. So if you buy calls, you want your call to expire in the money, which means you want the strike price of your call to be below the current price of the stock. Right? Conversely, if you sell calls, right, you want them to expire out of the money. You want the strike price to be above the current price of the stock. Now, if you reverse this to the put side, if you're the buyer of puts, you want your put to expire in the money. An in the money put is where the strike price of your option is above the current price of the stock. And if you're a seller of puts, they will have zero value if they're out of the money at expiration. So if you're a seller of puts, you want them to expire out of the money where the strike price is below the current price of the stock. If you master those things, it's going to be really easy, lickety-split when we talk about these option strategies. So thanks for tuning in, guys. Hit me up in the comments below, and I'll be seeing you guys in the next video.